Okay, welcome everyone. It's 7 o'clock, just after, so let's get started. Somebody give me a thumbs up or type in the chat feature if you can hear me and see my screen. Okay, I got a couple thumbs up there, so we are good to go. Let's start at the top of the class with the exam. I got a couple questions back on some of the questions. And remember, the exam window closes tonight at 11:59. So if you haven't taken it yet, you can still take it. And when the exam window closes at 11:59, everybody in class is going to be able to log back in, and that's when you'll see full explanations of every question on the exam. So go back, look at what you answered, look at what the correct answer is. If you missed it, there should be an explanation there. In my experience with past classes, most of the time that satisfies students in the class. 95% of all of your questions will be answered. And if you still feel like something was unfair or unclear, let me know and we'll get your grade corrected if we need to. Because, I mean, writing multiple choice exams is it's hard. I mean, to get good exam questions that test the material, that aren't gotcha questions, it's challenging. So if you take issue with anything that was on the exam, let me know and we'll get your grade adjusted. But my experience tells me that most of the time you have one of those crap moments where, like, I knew that, I just didn't answer it. So that should add some clarity. Okay. So other questions before I dive into, I'm going to lecture over Module 7 tonight, liability recognition and non-owner financing. It's not a terribly involved lecture. Got about 50 slides I'm going to try to work through. I'm not going to hit them all. I'm going to get through most of the easy ones and try to take a deeper dive on some of the more technical material. But I like to take questions at the top of the class so that everybody in class gets the benefit of anything that you might be confused about. You know how it works. What's up?
Hey, Vern, just the window you have open for an exam seems to be a couple weeks, right? So the exam window for exam 2, according to the syllabus, opens on 3/16. I'm trying to just think about how long the window is going to be for exam 2, just to try and plan out when to take it.
Thinking ahead, I like it. Well, let's see. I'm going to lecture over Module 7 tonight, and then next week's Module 8. So what's today? Today's the 2nd. So I could open it as soon as the 10th. I know the syllabus says the 16th, but I mean, I could open it before then, which just gives you more time, and I'm okay with that. I mean, I don't. It's really just when it closes that matters. So I could give you potentially 2 weeks. It'll open sometime during that week.
So I am wondering when it'll close because I'm wondering where to throw effort on the project and then when to get the exam done, I think is my strategy. So I'm wondering if you think you are going to like open it, like I wonder when it's going to close then, I guess is my ultimate question.
Yeah, so let me look at my calendar here. Okay, let's see. Here's my calendar. Okay, tonight's the 2nd. Next week is the 9th. So that will be Module 8. So that will complete the testable material. And then I like to I like for a week to go by, so everybody in the class has an opportunity to ask questions over the testable material. So that would be the 16th. And then I like to give a week to take the exam. So the syllabus has the exam open from the 16th through the 23rd. And I always have the exam close at 11:59 following the week of the last testable material. So you're looking at a close date of March 23rd at 11:59 p.m. Does that help?
Yes.
Okay.
And can you just confirm, what's the time limit on the exam again?
Yeah, 2 hours, I think, but I can go in there and,
It's 2 hours.
okay, thank you.
Thank you.
I got confused on the class timings and I missed the last in-class discussion. Was there anything on class 5 about the project that I might have missed?
I don't recall, generally I throw it open to questions about the project every time we get together. So there might have been some discussion of it, but nothing that I had specifically reserved to talk about.
Okay.
And having said that, I will also note that as we go through the material for every lecture, I try to point out what's going to be relevant to that class project. And remember, you can always find those lectures out there on our YouTube channel. So I posted module 5. It's right there. So you can go watch it.
Perfect. Thank you.
So module 6 is due this evening then?
You mean the homework?
Yes.
Yes. And recall there's no late penalty. So yes, it's due tonight, but if you need more time, you're not going to get penalized for it.
Thank you.
Mhm. Okay, let's dive into module 7. Okay. Evaluating accounting for accrued liabilities. We've briefly touched on this a couple of times this semester already, and we're going to go a little bit deeper into the accounting tonight. What is an accrued liability? If you recall from your first accounting class, and even, I think it was even module 1 of this accounting class, we reviewed the basic accounting cycle. So you open the books and you make entries throughout for different transactions. And at the end of the accounting period, we have to go through the closing of all our books. But before that, we have to make any adjustments for items that might have accrued that didn't have a specific transaction associated with them. And the classic example of this that we give is wages payable. So you get to the end of the accounting cycle and maybe the next payday doesn't fall neatly on December 31st, but we've accrued or we owe our employees some wages. So we have to accrue for those, which is going to mean that we have to make an entry on our books that accurately reflects what we owe before we can close the accounting statements and then subsequently publish all of the financials. So you'll see here a listing of current liabilities on Verizon's balance sheet, and those show up as a separate entry. So anytime you look at a balance sheet, you're going to see current liabilities and then long-term liabilities, which shows up down below current liabilities. And inside the current liabilities section, you're going to see debt maturing within 1 year, and then accounts payable and other current liabilities. And I'll show you how these accruals show up in the current liabilities section. So they come in 2 flavors. You have the routine contractual liabilities, which is where that wages payable example would show up. Other examples might include unpaid interest that has been accrued or that we owe at the end of an accounting cycle, income taxes, other expenses. And then the second category are contingent liabilities. These are liabilities that have some uncertainty associated with them, such as litigation brought on against the company. It may be likely that we'll pay in the future, so there's a liability associated with that, but we don't know with certainty what the amount's going to be. Similarly, warranty liabilities fall underneath that category. You know, we may have some historical precedent for paying out liabilities associated with warranties, but we don't know with certainty, you know, what percentage of a product line is going to go bad, which ultimately determines the warranty expense. Let's look at that wages payable example that I mentioned just a minute ago. Here we have at the end of the period 1, we need to accrue $75 for employee wages that were earned by an employee at the end of the period, but haven't been paid yet. So we are going to book a credit to wages payable in the amount of $75. And then we are going to debit wages expense in the amount of $75. And you see wages expense flows through to retained earnings on the income statement there. Now in period 2, when we actually pay the money out to the employees, well, we're going to credit cash for $75 and we're going to debit wages payable for $75. And the credit in the first entry and the debit in the second entry offset so that we will then have a zero balance for wages payable. And that's the basic format that we're going to use for all of the accrual entries that we would make in accrual accounting for liabilities. Unearned revenue. Recall I mentioned unearned revenue in module 5 the last time we got together. You'll also see this referred to as deferred revenue. Just know those are the same terms. They go by different names. Unearned revenue is a contractual obligation that we have to deliver goods or services in the future. And because it's a contractual obligation, that is actually a liability. We owe it. We don't owe cash, but we owe it. We owe the goods. We owe the services. And until those goods or services are delivered, that liability will exist on our books. So we have to record it. And the challenging aspect of that is that the naming convention for that liability is unearned revenue, which seems like an asset, seems like something that we should record as a positive, but it actually shows up on our books as a liability. So a credit or a negative to our income statement accounts. Okay, let's talk a little bit about some accruals for other types of contingent liabilities. We have examples that include guarantees on debt, lawsuits, product warranties, environmental disasters, and remediation. All of these things are uncertain. When we face an uncertain or contingent liability, we look for two things to be able to record it on the balance sheet. We need to first know that it's probable. So more likely than not to occur in the future. So we may have a lawsuit outstanding and simply not know how probable it is that it's going to rule against us. You know, unless we have some means by which to determine probability, then we're not even going to record a lawsuit on our books, or any of these for that matter. The second one is that it has to be reasonably determined. So what basis do we have for putting this liability on our books at all? Can we estimate it? If for some environmental disasters, I mean, if you're in the oil and natural gas business, then yeah, sure, there's probably some reasonable likelihood, some probability that in the future, you're going to be subject to environmental remediation of some kind. But to what degree? Not reasonably determined. So you see, you know, most of those contingent liabilities go unrecorded on the balance sheets of oil and natural gas drillers. Okay, let's look at an example in warranties expense. Warranties expense is a good example of a contingent liability that meets both of those criteria of probable and estimable, or reasonably determined. And with most companies, say Ford or Chrysler or GM or even Apple, they have a substantial enough operating history. They know that typically 2 to 3%, I'm picking these numbers randomly, 2 to 3% of their product line is going to be sent back with some warranty issue, and they're going to have to replace that. And because they've made that promise in the past, they know that they're going to have to either issue a new phone or issue a recall or replace some part on that car. And with that data, they can make a reasonable estimation of the value associated with that liability. So we do just that. We look at operating history. We know that 2 or 3% of goods go bad. And now we can estimate what that liability is going to be at the beginning and end of the year. And this is an example of the footnote that you'll see in most 10Ks for firms that have a manufacturing business. And if you're doing research on a company that's anything related to manufacturing in nature and might be subject to warranty expense, find this footnote in your 10K filing. You need to familiarize yourself with this, because this is another one of those examples where management can play games with the accounting, because as you've probably already cued in on, there's a lot of estimates that go into this. And anytime in accounting where management has at their discretion the ability to make an estimate, there's an opportunity for gamesmanship, shenanigans, find the penny, call it whatever you want. You can make the financials look better or worse. And if your bonus depends on it, probably a pretty safe bet that it's going to be, at the very minimum, a temptation to do so, which is why we start the semester with the question, how do your teams get paid? So let's walk through this. This table is going to show you the balance of warranties, warranty payable, what is this? Hold on a minute here. The balance of warranty payable at the beginning of the period, 94.2. Warranties issued during the period. This was an expense. So an expense of 53, probably million here we're looking at. Settlements made during the period was close to 80 million. Recalls, 63 million. And then the balance of Harley-Davidson's warranty reserve was 94.2 at the end of the period. So this is much like what we recorded in Module 5 when we looked at accounts payable or accounts receivable and the allowance for uncollectible accounts, or when we looked at Module 5, which was we had another example in there too that I'm spacing on right now. It'll come to me. But you can see that we use the estimate to make a reserve. And then as the warranty expense comes in, or as the products go bad, we actually book the expense against the reserve. And at the end of the period, we see how well or deficient were we when we made those estimates. And that's going to inform the estimates that we'll make in future years. Okay, warranty disclosures, everything that you would want to know about how those estimates are made are in the disclosures. What are the estimated costs? What percentage of the product line does the company assume is going to go bad? When these things are disclosed, you want to look at those over time, and you want to look at those relative to the competition. And if you see anything that stands out, that's probably a little pink flag that you might want to do a little bit more digging to make sure management is not purposefully underestimating or overestimating their warranty expense. So if warranty expense has been 2% of revenues for the last 10 years, and now all of a sudden it becomes 4% of revenues, well, that might give you a little indication that the management team is trying to depress its current income, which is not uncommon. So If any of you ever land a job as CEO, and you're probably going to get stock options associated with that. Well, it's not uncommon for newly minted CEOs to come in and want to purposely drive down the value of that stock, because the vesting price of those options will typically take place over 30 to 60 to 90, sometimes 180 or even 360 days from the time a CEO takes office. So it behooves a new CEO to drive that stock price down so that the vesting price of those options is as low as they can possibly get. And they do this with all kinds of different mechanisms. You can declare restructurings. You might be able to adjust your warranty expense. You can do it just through job owning. You get on the phone with the analyst and you're like, I'm so happy to be here. I'm your new CEO. I've met all my associates, and well, man, things are a lot worse than I really thought they were. Okay, what's Wall Street do? Well, Wall Street panics. They sell your stock. A quarter later, 90 days later, you get on the phone call with the analyst. Now what do you say? You say, well, it was bad. It was really bad, but you're lucky that I'm such a talented CEO. I'm going to pat myself on the back. We just reported great numbers. What's the stock price do? Moves up in the other direction. What happens to your wallet as a result of talking the stock price down and then talking it back up? All of your options vested at a lower price. Now your net worth is much higher than it otherwise would have been. This happens all the time. And now that you've taken this class, you may be able to recognize some of the accounting maneuvers that go along with it. Okay. Analyst adjustments. When you see this happening, now that you're armed with a little bit of the information and an understanding of the accounting, it's no big deal to take the numbers that are presented and adjust them on a pro forma basis or on an as if basis and restate them. So just because the management team is playing games with the numbers doesn't mean that you have to. You can take the numbers and just switch them back. So if for the last 10 years, a company has been reporting warranty expense that's 2% of gross sales, and all of a sudden they make it 4% of gross sales, well, you don't have to rely on that number. You can just switch it back. You can say, well, what would warranty expense have been if it were 2% of sales? And then restate the income statement. It's a job to do that, but unfortunately, we have the accounting software to make it a little bit easier on us, and the testable material in this class isn't terribly rough. So what you would want to do in that instance is you would want to take warranty expense, average it over the last 3 years, and divide by total revenues. So that will tell you that warranty expense for the last 3 years averaged 1.8%. Now you take that 1.8% and you apply it to total revenues. So now you have an adjusted warranty expense. The difference between and then the difference would be the adjustment. So in 2016, you're going to add 5,000 to warranty expense. Same way in 17, and then in 18 you would subtract 11,000, and you just let those numbers trickle through the income statement to get adjusted net income numbers and ultimately adjusted earnings per share numbers. And with those adjusted earnings per share numbers, you can likely see how much the CEO just paid himself or herself, because their bonus is going to be tied to earnings per share, most likely, or some ratio that's similarly affected. And now you know. Moving on to short-term debt. I can move pretty quickly through this one. Short-term debt, you'd really just need to be familiar with the terms. Know that a note payable is typically very short-term, sometimes 30 days or less. At the end of the accounting period, we're going to accrue for interest payable that hasn't yet left the company in terms of cash. That entry looks exactly like warranty expense. Only instead of a warranty payable, we have an interest payable. and an interest expense. And then when the cash goes out the door, we credit cash and debit interest payable. These two terms net out, so your interest payable balance becomes 0 at that point. Okay, current maturities of long-term debt. This is a table that you need to find in your 10K filing for your research project. And be familiar with these numbers. These are principal payments on long-term debt. So here's the principal balance, and you're going to see the annual payment over here. So what you want to know as an analyst is, what's the company's plan for coming up with $224 million worth of cash each of the next 5 years? If your company's earning $1 billion in cash every year, well, they don't need a plan. They just need to keep doing what they've been doing. No big deal. But if last year your company only earned 100 million and next year they got to come up with 200 million, well, that's a pink flag. Now you as the analyst have to ask some difficult questions. Where are you coming up with that money? And if their plan is to refinance that debt, meaning not pay it off, we'll just go to another bank and get a new loan, which is tantamount to just taking a credit card and paying off your old credit card balance with a new credit card, that's not a very good plan. Now, companies utilize that plan all the time. It's way more common than it should be, but I guarantee you, as soon as we find ourselves in another credit crunch like we did in 2008, 2009, 2011, those companies are going to be in trouble, and a lot of them are going to go bankrupt. So raise the alarm bell. Ring the alarm bell if you see that. Bring it to my attention in the executive summary of your research project. Okay, long-term debt pricing.
Hey, sorry, Vern, when you talk about something like a credit crunch, you're meaning like, hey, a lot of these companies were over leveraged and then they kept kicking the can, and then when the bill came due, it was like, well, we don't really have the money for this.
Yeah, when I say credit crunch, I mean something happens in the economy and it becomes more difficult for banking institutions to lend. Right now, money's real loose. It's easy to get a loan from a bank. So if your strategy is the one that I just laid out there, when it's time to pay our debts, we're just going to get a new loan from the bank. In times like today, that's a workable strategy. Not a lot of risk there. But in a credit crunch, something happens in the economy, like take COVID-19. Before the government, before Congress pushed $4 trillion worth of stimulus into the economy, we were starting to seize up. And without those monies, we would be in a big time credit crunch, because a lot of those businesses would be suffering, and a lot of the debts that were owed would not have been paid. A lot of those debts would have gone bad. Banking institutions across the United States would have taken millions, billions of losses. And the likelihood that just any old company is going to be able to get a loan in that environment is very, very slim. And that's kind of what happened in 2008. We went over a financial cliff, and we saw Bear Stearns go broke and Lehman Brothers go broke, and several other major banking institutions almost went broke. And that took a lot of credit out of the banking system. It made it very, very hard to get a loan. The only companies that could get loans were the ones that didn't need it. So, and that happens periodically. You're going to see that happen in the economy. You probably see credit crunches crop up every 10 to 15 years in a big, big way. So you hear Buffett harp on this. A lot of people give Buffett a hard time for holding so much cash, Warren Buffett. But he does that on purpose because he's familiar with these cycles. He's familiar with how credit crunches work, and he knows that if he's holding liquidity when nobody else is, he's going to be able to put massive amounts of cash to work very, very cheaply. I think it was 2008, maybe 2009, we went to the Berkshire Hathaway annual shareholders meeting. We go almost every year. I always have passes. If any of you want to pass, let me know. I'll get you a pass. It's a great event. Put it on your bucket list. Absolutely fantastic. But we show up and it's Buffett and his partner Charlie up there sitting at a card table, drinking Coca-Cola, eating See's candy, which they own both of. And they're putting on their show. And it sounds like it would just be dull as all get out, but it's actually pretty cool to watch these two old codgers up there taking Q&A for 6 hours, and they do a good job of it, and they're hysterical. But at this particular meeting, after the great financial crisis, Buffett opened with something that was like a stopwatch. Tick, tock, tick, tock, tick, tock. And he's like, you hear each of those? Every tick is 8 million that Goldman Sachs owns me. Because he had loaned them, I don't know, some outrageous amount of money, like $1 billion. And he basically bailed them out. And in doing so, was able to get more generous terms than Goldman Sachs had ever given anybody in their entire history. And it was made for a pretty good show, and Buffett hammed it up. And that's exactly what's out there to, people who have cash at the right time when everybody else needs it. So we are talking about issuing a bond. I forget which lecture this is. I think there might be another lecture later in the semester that's 100% dedicated to bonds and bond pricing. I think so. So I won't go terribly deep, but I need for everybody in this class to understand that when we issue a bond, and remember, a bond is nothing more than just borrowing money from the brokerage houses in New York, so Wall Street. We go to Wall Street and we make hundreds of small bonds. We sell bonds. A bond is it's like a stock, but it's a debt security, and they're typically denominated in units of 1,000. So, Jim, that would be like me borrowing $1,000 from you, and in exchange for that transaction, I give you a piece of paper that looks like a stock, but it's actually a bond. And then you can sell it to Matt, and Matt, you can sell it to Carly, and Carly, you can sell it to Yasmin, and they trade like stocks in the public markets. Well, just because that bond says that it's worth $1,000 doesn't mean that's what you're going to buy it for. It might say it's worth $1,000, but actually sell for $950 or $1,050, and that's based on the interest rate that it pays, and those interest rates are relative to the daily quotations that you see in the market. So if my bond pays 5%, but all of a sudden interest rates in the market are at 5.5 or 6%, well, that's going to make my bond relatively less attractive, and that attractiveness is measured by the price investors are willing to pay. So if my bond only pays 5%, chances are I'm only going to be able to sell it for $9.50 or $9.25. And those differences show up on the balance sheet in what we call a discount or a premium. And there's special accounting associated with discounts and premiums. Okay, I think I touched on all that. Yep, hit on all that. Okay, some terminology that you need to know when it comes to bonds. You need to know the coupon rate. The coupon or stated rate, that's the number printed on the face of the piece of paper that's issued as the bond. So that's the 5% in my example. I issue a bond at 5%. Now the market yield or rate is what the market's actually paying. So on a relative basis, other bonds in the market might be paying 6 or 7. That's going to affect the price of the bond. So if my stated rate is 5 and the market rate is 6, then the price of my bond is going down, and it will go down until the effective yield on that bond is equal to the market rate. Okay, another example, say this is 5, but the effective market rate is 4. Well, the price of my bond is going to go up until the effective yield on that bond is 4%. Now, what do I mean when I say effective yield? Well, the effective yield is the actual coupon, so the 5% times the face value. So if my bond pays 5% and it's $1,000 bond, that means every year, we get $50. Is that right? 5% times 1,000. Yeah, $50. Okay, so if my bond pays $50, but in the example I just gave, it has to yield 6%. Well, that means the price has to fall to, I don't know, I'm making up numbers here, but say it fell to $9.50. Now that effective yield is comprised of the interest payment of 50 and the $50 that you're going to receive when this bond is redeemed at the end of its life. Now these two numbers, $50 in capital gains and $50 in interest payments, effectively make that yield 6%. And I know that's confusing, which is why we're going to take a couple examples. More terminology first. Bonds have two payment streams. They have periodic interest payments. Those interest payments is the $50 that I just mentioned. That's an annuity. You're going to turn on those interest payments for a period of time, usually 10 years. 10 years of $50 payments semi-annually, so $25 every 6 months for 10 years. And then at the end of that period of payments, you're going to get a single premium repayment, which is the principal value of the bond, and that's a lump sum. So let's do a little bit of simple time value of money. In this example, we have a $10 million bond with a 6% coupon rate or face value, face rate, matures in 10 years. So maturing in 10 years will result in 20 semi-annual payments. Semi-annual payment is going to be 10 years times 2. We have $10 million times 3% interest. That's 300,000. The total of those cash flows are 6 million. And then at the end of that period, you get your $10 million back for $16 million worth of total cash flows. Not too bad. Now, if you take those interest payments of 300,000 and you take that principal payment of 10 million and you discount them back to time zero, either using your financial calculator or your Excel spreadsheet or your present value of an annuity factor, you're going to get a present value for each of those streams or each of those payments right there, and they're going to total the face value of the bond at 10 million. Okay, another example. If instead an investor demands 4%, so when we say an investor demands, we could just as easily say the market yields. So what are other similar bonds trading for? If they're trading at 4%, well, now all of a sudden our bond's going to be required to yield 4%. And the only way that happens is if the face value of the bond declines, not the face value, but the market value. So basically, we know that our payment is 300,000. We know our principal is 10 million. So we're going to discount those cash flows back at 4% rather than the 3% face value. We can use that. We can do that with a financial calculator. We can do that with Excel, or we can do that with our annuity factors here. Here's our present values, and this is the value of our bond today if it's priced to yield 4%. That's a discount. So the face value is 10 million. If it's priced at 8.6 million, we call that a discount. Now, other way around, let's look at what happens if we have a premium. So in this instance, the market yields 2%. Same math, discount those cash flows back at 2%, and you can see that now the bond is worth 11.6 million. Investors are willing to pay more for a bond that has an interest rate greater than the current market. We call that a premium, and there's special accounting associated with a bond premium. let's look at this example that our authors give us of Verizon. They're making the distinction between the effective cost of debt and how that's used to determine interest expense. So you can see here on this prospectus supplement that Verizon's offering bonds to the public with a small discount of 0.3%. And you can get all the details associated with those. That's not really what I was looking for. I wanted to Verizon's coupon versus effective rate. Okay, okay. Okay, I was right. That was a high-level overview of discounts and premiums. I think it might be module 8 or 9. We'll take a deeper dive into the accounting associated with discounts or premiums. So for the purposes of module 7, primarily what you want to know is just to have a familiarity with the terminology and know how discounts and premiums move in association with the interest rate and the difference between the coupon rate printed on the bond and the market rate, which is the kind of the availability of other interest rates out there in the market. Okay, this is one of the tables that I was reaching for a little bit earlier. I was a little premature in that, but I wanted to give everybody a heads up that this is another one of those tables that you need to find in the back of your 10K filing. This is going to show you a complete listing of all the debt outstanding for your particular business and when it comes due. So just like in the previous table where I advised that if you had debt coming due and you didn't know what the plan was to pay it off, you need to be asking some difficult questions. Well, this is a similar table. This is going to show you the maturities, what's due, the rates associated with that. And when we get a little bit later in the semester and we start talking about discounted cash flow analysis, and many of you in this class have already had some training on discounted cash flow analysis through your investing program or just other exposure, you're going to be asked to calculate a weighted average cost of capital. Well, this is where you might go to give you some insights into that weighted average cost of capital. And when you get into, oh, I forget who at UMKC is teaching it now, but some corporate budgeting classes or some M&A type classes, oftentimes the question becomes, what would we have to pay if we wanted to do some M&A transaction and we wanted to finance it with debt? Well, to answer that question, you come out here to this schedule, because what you're going to have to pay is more than what the company is already paying. And what I mean by that is, say for example, you got one issue out here that yields 4%, then there's a 5.1, then there's a 6.9, then there's an 8.95. Looks like 8.95. That's the highest. So just think about that from a common sense aspect for a minute. Some banking institution was willing to lend to Verizon at an interest rate of 8.95. Now Verizon wants to take on more debt. Anytime an institution takes on more debt, if it's meaning of similar nature, so similar collateral, it becomes more risky. And if something's going to become more risky, the interest rate associated with that debt would have to be higher. So now you know that if they're going to finance any future M&A activity, they're going to have to pay 9% or more to do that, or they're going to have to give more favorable terms. And that's why a table like this becomes so meaningful to corporate finance types. Okay, here's another heads up as we get ourselves familiar with the concepts of a premium or a discount. If your bonds are trading at a discount, so you issued them for $1,000 maybe several years ago, and then the interest rate environment changed, and now they're trading at 700, which is the example that they give here. Here's Verizon has 700 million in 2008. So maybe they initially issued 100 million, and now they can buy those bonds back at 700 million. Sometimes that becomes a very savvy move that management teams will execute, and when they do that, they're going to book a gain or a loss on the repurchase of those bonds. It's not too dissimilar from what you see a lot of companies doing nowadays and buying back their own stock. Well, if you have debt outstanding and that debt trades in the public markets and it gets a lot cheaper, sometimes it makes sense to buy that back. Or maybe it even makes sense to buy back and take a loss on it, which you don't see as often, but sometimes that does occur. Okay. Note that GAAP requires companies to report current fair values of their debt in the footnotes, but not on the balance sheet. And there are some subtleties associated with that that we'll go into later in the semester. Okay, credit ratings. Anytime a company issues a debt, it's going to have a credit rating associated with this. And you can think of a credit rating, well, the ratings don't look too dissimilar from the grades you're going to get in this class, the A, B, C, D, E, F. And I'll show you how those break down, but you can think of it very much like a school grading system, which measures the credit worthiness of the institution issuing the debt. And these are issued by companies like Standard & Poor's, Fitch, Moody's, and they're so institutionalized and so standardized, and they've become such a common part of the debt issuance system, mechanism, machine, that investors have come to understand what interest rates are associated with each one of these ratings. So when I quote market rate, I'm usually referring to the market rate for a similarly rated debt institution or issue. So let's look at how those ratings come about. A rating institution is going to look at the market rate of interest, which is always broken down into the risk-free rate. So the yield on US government borrowings is always going to be the risk-free rate or the lowest rate that's out there in the market. Every other issuer, every other borrower that wants to issue bonds in the marketplace is going to have to pay that rate, the risk-free rate, plus something else. That plus something else is called the risk premium, and that risk premium is going to depend upon the borrower's credit risk or credit worthiness, as the case may be. Now, how do you measure that credit worthiness? We'll get into that in a minute, but you can see how various borrowers of different credit worthiness have fared over time. So what we're looking at here is the 10-year treasury. That's that US government rate. That's that risk-free rate in red. Now, typically a AAA rated bond will fluctuate, I think it's 2 to 3% above the 10-year treasury. It's less than that now. Those spreads have narrowed quite a bit. But you can see how they've varied over time. Now, there's right in that range, the difference is what we call a spread. That's a pretty wide spread historically. And then in the blue, you have BAA. Those are slightly less creditworthy. These are not as safe. And you can see that they pay a little bit more of an interest rate because they're riskier. And you can see that that spread between AAA, and that spread between risk-free treasuries varies over time. You know, the right in there, that's probably the widest spread that we've seen in the last 10 years, somewhere there around December of 15. I think that might have been, oh, was that the taper tantrum? I think that might have been in there somewhere. Here's a breakdown of the 3 most common rating agencies, S&P, Moody's, and Fitch. And you can see they're similar. AAA, AA, all the way down to single A. We're decreasing in credit quality. And then all the way down to D would be the worst if you're using S&P's system. So look those over, familiarize yourself with just kind of how they lay out. And then this is the most important line on the page, this little dotted green line. That's the line of demarcation between what the market refers to as investment grade. I'll put an I there for investment grade on this side of the line. And then below the line is speculative or high yield, or what used to be called junk. So when you get below the line, your interest rates go up significantly, although here recently high yield bonds have, they actually yield as little as they ever have, which says a little something about the market's willingness to accommodate risk right now. There's a lot of risk takers in the market. But you'll see interest rates jump significantly as companies fall on one side of that line or the other side of that line. So know what for your research project, know what your company's credit rating is. And if they're BBB minus, right on the borderline between investment grade and high yield, understand where their credit ratios are and understand what risk is associated with them potentially falling to high yield. Because if they do fall into high yield, they could lose access to credit. So here's an example of how S&P assesses credit ratings. And think about what the owner of a bond is interested in. The owner of a bond is interested in 2 things. And those 2 things were the different types of cash flows. One were the interest payments. And then secondly, they were interested in the principal repayment. Well, both of those are related to cash flow, and insofar as the interest expense is concerned, that's just a couple lines up on the income statement than net income. So a bondholder is interested in everything that an equity holder is interested in. So if you go all the way back to Module 1 and start with the basic framework for this whole class, which was Porter's 5 forces and competitive analysis and SWOT analysis and analysis of the financials, income statement, balance sheet, statement of cash flows. Everything that we're doing throughout this whole class is also going to be of interest to a bond holder, or in this case, S&P, as they try to put a rating or a grade on one of these bonds or companies. And they lay it out like this. They assess country risk. You know, where does the business exist? Where do they do? Where do they compete? Industry risk. You know, how risky is the industry? Is it high tech or oil and natural gas or consumer durables, or the travel and leisure might be risky in this environment? What's their competitive position look like? This is all Porter's 5 forces type stuff. And then you get into the financial assessment, cash flow, leverage, so on and so forth. And they put all that into kind of a big system, and then they add on, you know, what's their capital structure look like, financial policy, liquidity, governance, and other comparable ratings. And all that leads to some type of credit rating published by S&P. And you can see here the example of Verizon's, and they give you a little bit of an assessment on what went into Verizon's BBB+ credit rating. And if you look at Verizon, our authors include here, you know, some some of the commentary. This comes straight out of their 10K filing, where you can see what management's internal goals were for their discretionary cash flow and adjusted debt to EBITDA numbers. And they actually have been trending in the right direction, which means that a company like S&P is going to be inclined to give them a favorable watch, or a debt rating that's trending in the upwards direction. And generally, that's a pretty favorable thing. Okay, I mentioned a moment ago that if you were on the borderline between investment grade and non-investment grade, which would be right here, it might also be of interest to you as an analyst to know, well, when do we get dropped? And one indication of that might be some of the ratios that are typical for an investment grade firm, or for a non-investment grade firm, or high yield. So if you're worried about dropping from investment grade to high yield, you might want to make sure that your EBITDA to average assets stays above 10%, or EBITDA to interest expense stays above, mid-single digits. Here's your margins, here's your operating margins. And you can look at all those ratios independent of one another to see if there's any red flags that present themselves. Here's a nice chart that just kind of graphically depicts the default rates for ratings since 2004. And again, you can see why the line is right there between investment grade and non-investment grade, because the defaults start to move up really fast when you get down on the right side of that line over here, with everything to the left being pretty safe. Now, remember, this is only since 2014, and we haven't even had an economic recession since 2014. You might be able to count COVID, but the government moved so quickly getting that stimulus into the market, and markets rallied by 30%. I'm hesitant to even count it. So in a recession, those numbers would look different. Okay, and then we are into the appendix, and I am not going to lecture on time value of money concepts at this point in your collegiate experiences. You have had that lecture more than once, so look that material over on your own time. Should be all review there. Okay, so, well, we finished early. So I'm going to put some time back in your calendars this evening. But before we call it, any other questions or anything we need to touch on before we adjourn? Okay, gang, hearing none, I'm just going to say thanks. I'll have this lecture posted to YouTube shortly, and give me a call or a ring if you need
Hello,
anything.
Professor. I have a question, but it's about the homework. I don't know. It's a question about the homework or module 7. It's a, let me see. It's a, the third part, it's ask about the market value of the notes on the date on or certain date. I didn't, after I read the whole module and view the lectures, I don't think I get any information about this question. So I wonder whether you can give me any clues on how. I didn't find the answers on the quick the quizzes you posted to the Canvas either.
Eva, did you email me about this? Am I behind?
Oh, it's a different one. That one I already figured out, but this is the new one, it's module
Oh,
7.
okay. Well, I'm glad, I'm glad you figured the one out. Nice work. For module 7, because I can't see what you're looking at right now,
Mhm.
it really helps me out if you'll send me a screenshot and then I'll reply and hopefully be able to point you in the right direction.
Okay, that sounds great. Thank you.
Okay, yeah, sure thing.
Mm.
So,
I have a question, but it's completely non-class related. So if somebody has anything to ask about class, like feel free. And then if you want to stop the recording before I ask my question, like you're welcome to.
okay, sure.